Welcome back everyone, as earnings volatility just continues to ramp up. If we see how the market performed yesterday, lots of red, double digit in fact for some companies that we ran through in detail in an earlier episode. We can also see when we zoom out to the last week, still lots of red, even hitting the Mag 7, Amazon down around 5%. You really have to go back to around a month's time to see some progress, but then we still continue that double digit negative results for many companies. Now, today's episode, we want to focus on companies that have not only been battered down, but upside is looking very nice. We're talking 45% for one company, another we've got 52%, and that is going to be the general trend for the episode today. Companies with lots of upside and that do look beaten down and ready for a buy. Now, the first one we're covering, and we will get into the valuation of each one of these six, is Adobe, down 34% over the last year. Year to date, down 24%. Now, over the last 10 years, they've still, with these drops, managed to outperform the S&P up 293%, but they're trading pretty much at a 52-week low, with both Seeking Alpha and Wall Street giving these a buy rating. Wall Street 4.1 out of 5, fairly attractive, and the valuation is getting very low. We're talking below 17. This is a bit of a surprise for the company with these metrics, as we'll get onto, but actually we have noticed many investors chasing big names, stretching those valuations. And whilst they haven't reported anytime soon, we can in fact note on the 12th of June was their latest earnings. They performed another usual typical beat for Adobe, a double beat where we saw here earnings per share and revenue up double digit from the same quarter last year. However, earnings per share was down slightly from the previous quarter. And one thing that investors always question about this company is how can they continue to prove themselves with AI ramping up, competitors coming in and trying to take some of their pie. Now, what they actually did in that latest earnings was increase their expectations for both revenue as well as sales for 2025, something typically the market does like to see. And we can see that did fail to convince many about artificial intelligence and the effect it is going to have on their moat. But this is also a company that continues to buy back a lot of shares and have only been increasing it year after year. In fact, if we look at the last 10 years, they've been increasing share buybacks 19% every single year, something that's only ramped up even more. We're talking 7.6% on a share buyback yield, something extremely rare to see in the market today. With a valuation on an EV to EBIT, we're talking a decade low sitting around the 19 mark. This is truly a company that could be one for consideration in the portfolio, but you do also have to consider some of the risks, and that is why we always apply a margin of safety. Now, on the growth grade, they get a C-, but very consistent, 11% growth last year, 10% expected this year. That does sit above the sector, but we want to highlight it is a bit slower than the last 5 years for Adobe in particular, with earnings per share looking pretty attractive, 15% projected year on year, slightly above the sector at 14, and pretty much in line with their own historicals. Now, institutions with their 82% ownership, selling 19 billion in fact in the last year, have been buying more at 25 billion, and something we also note in the most recent quarter, buying a lot more than in fact selling. So they're very bullish on Adobe. They are in fact net buyers, and if you wanted to see the reversal of this trend, when in fact did institutions sell more than buy? Q3, although very marginally, and as we keep on going, you'd have to go Q4 2022. So one for quite some time now, institutions do quite like. And very briefly, looking at their underlying metrics before the valuation, free cash flow per share, we want consistent growth year on year. Very, very strong, not as perfect as maybe what we saw in yesterday's episode for Fortinet, but still increasing, and another large jump is anticipated into the next 12 months. We can see sales growth, yes, it is slowing down, but out of the last 10 years, double digit has been seen on each one. That is also expected to continue in 2025 with a very nice total sales growth. 5 billion 10 years ago, we're talking more than 4 times growth into 2024. As we said, they are doing share buybacks, buyback yield very, very high, ramped up over the last few years, and always great to see, especially for companies that don't pay dividends, as this is one way they return excess cash to investor pockets. ROIC, this is our favorite metric. In fact, alongside the net debt to EBITDA, 10% at a bare minimum to give us faith management are able to effectively allocate their capital, and we can see it's been increasing year on year, 36% on a trailing 12-month basis, whilst also highlighting our high quality company criteria. Not only revenue increases, improvements to their margin, 19%, now at 37%, free cash flow, this is a true free cash flow machine, very strong, very consistent, 42% on a trailing 12-month basis. Now, you might thought it doesn't get any better than that. While net debt to EBITDA, number of years it would take Adobe to pay off all of their debt net of cash on hand, correlates to balance sheet strength, while 0.1 on a trailing 12-month, expected to be there or thereabouts in the next year, highlighting Adobe very strong balance sheet at a fairly high glance. Now, jumping into the valuation, we get to $519, which, as you can see, is derived from the DCF model. Now, we'll just explain the most recent year. In fact, free cash flow grew 13%, average sits at 23%, and moving forwards, we've gone 8% year on year. As you can see, low, medium, and high numbers, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Adobe or any others. But based on the growth rate and the discount rate, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, giving us 519, indicating 54% upside. Now, just factor in on a reverse DCF model for Adobe, only 2.1% growth year on year is what is currently baked in. If you believe that is way too low, then we're looking at severe undervaluation. If you believe the opposite, then quite clearly overvaluation. We'll also highlight for transparency using 4%, $389, upside of 15, and using 12%, you can see 691, 104, that is more than a double. We've also tried to use a bit of a wider range on the growth rates, so it does give you a better idea. But at 8%, what we want to do here now is use a margin of safety. Remember, typically we kick off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy at 467, and as we keep on going till it's near the current trading price, effectively not at 40% just yet, you're pretty much looking bang on 35%. Wall Street themselves, $490 into 2026, upside of 45%. Adobe stock number 1, give us your thoughts, whether you see it as a buy, hold, or avoid. And we'll go one step further and be more conservative at the 4% rate. You are still, in fact, getting a margin of safety. We're talking 15% at $331, so sitting somewhere 10 to 15. On Adobe, though, do let us know your view. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's gone in the market in the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Lululemon, battered 18% in the last year, 50% year to date. They've lost one half of their market cap in just this year alone. Now, over the last 10 years, somehow they've still managed to marginally be around the performance of the S&P, up 193. They're trading at a 52-week low, very similar to Adobe, with a double buy from Seeking Alpha and Wall Street, although fairly weak, and we can see a very, very low forward valuation between 13 and 14. Now their latest earnings was quite some time ago on the 5th of June, where they were in line on EPS, marginal beat on the revenue. Whilst we did see growth on EPS and in fact revenue year on year, it was quite a large drawdown from the previous quarter. But just look at their valuation again, very similar to Adobe. We're talking about a company pretty much trading around a decade low, and they've also been spending a lot of money ramping up on those share buybacks, which is always great to see, as we said, especially for companies that don't pay a dividend. And in that latest earnings, they did talk about how tariffs will really hurt the company moving forwards. In fact, the share price alone dropped 20% off the back of that news, as well as citing here some pullback they've seen in consumer spending, and they also ended up cutting their overall profit outlook. So not looking good, at least in the shorter term, for Lululemon, and maybe why we do see a D+ on their growth grade. 9% revenue year on year, 8% expected this year, still above the sector in the low single digit, but historically this one grew at a very fast rate, much higher than current year expectations. EPS still not looking bad at 10%, in line with the sector, but again lower than their historical of 17. Now institutions, 85% ownership, selling $6.5 billion, bought a little bit more at 7.7, but we've noticed by a very small margin they have become net sellers in Q2. Prior to that, you'd only have to go back to Q3 2024 to see another sell over by quarter. And their free cash flow per share does look good in terms of moving in the right direction, although very inconsistent. That is expected to continue over the next 12 months. We do see year-on-year double-digit sales growth. We can see a bit of a slowdown, and very significantly from 2022. Nonetheless, top line has grown 5 times in the last 10 years. Not something we would expect perhaps in the following 10 years if they aren't able to really revamp that growth levels to what we've seen previously. Shares outstanding, looking good. As we highlighted, they have been ramping up those share buybacks, and in particular ROIC, whilst it hasn't been increasing, very consistently pulling out some very strong numbers, 33% in 2025. Margins, no complaints whatsoever. Efficiencies noted in the last 10 years. Margins also looking above the 5% minimum level, and net debt to EBITDA very similar to Adobe, very marginal, 0.1 on a trailing 12 month, looking very strong. Now, intrinsic value at $331 is derived using a growth rate of 6%. If you believe 10% more appropriate, then we're talking more than a double, 131%. Baked in, if you're buying at this current price, negative 1.1% growth to their future free cash flow. So it does look like another potential great opportunity. And as we keep on going in terms of a margin of safety today, at 40%, still looking like a buy. We're talking around the 40 to 45. Wall Street see this 290 into next year, upside of 52%. Lululemon may be one on your radar as a value play, but do give us your thoughts. And we'll go another step further. Let's say they only grow by 2% year on year to the future free cash flow. You are still getting a margin of safety, quite significant as well, around the 20 to 25% mark. Like Adobe, give us your thoughts. Is Lululemon a buy, hold, or avoid? We then move on to Salesforce, pretty much flat over the last year. Year to date, down 28%. Over the last 10 years, though, marginally outperforming the S&P, up to 130%. Again, another one trading around the 52-week low, with a double buy from Seeking Alpha and Wall Street. Wall Street 4.35, not far off the 4.5 for a strong buy rating. And they too, similar to what we just saw, in fact, from Lululemon reported a few months ago, where we saw a marginal double beat. And whilst they were growing year on year, slight decrease from the previous quarter, but we actually got to see them raise their full year sales outlook, something markets always love. But just yesterday, we saw Google disclose a data breach via Salesforce hack, something that ultimately doesn't look good on the company, and a large reason for the 3% drop that we just saw yesterday. Now, valuation at 21 is below the 5-year of 31. That is a severe undervaluation signal, whilst you're also getting a yield 0.7% above the historical 0.6. And that's something that's also confirmed when we look at the blue tunnel. Remember, within these parameters, highlights fair value. We're seeing disparity between where it sits today and the bottom end. although one thing we don't like is the fact fair value has been decreasing in the last year. But if we do zoom out to the last 5 years, one thing that is very clear, this company for a very large portion has been trading in a severely undervalued level, perhaps highlighting this is one that is typically unloved by the market. Now, growth at a C, we're talking 8 to 9% year on year and expected this year, only slightly higher than what we've noticed from the sector, but similar to the two previous companies, this one was growing historically at a faster rate. EPS 17% above, in fact, the sector at 14, slightly below historical 20, and institutions with their 80% ownership selling 24 billion have been buying a lot more at 37, also buying a lot more in the most recent quarter, so very bullish, they're net buyers, and if we keep going to see the reversal by quite some distance, you'd have to go to around Q3 2023, one that we would say institutions for the large part do in fact like. Now, free cash flow per share, very nice to see consistent growth and expected over the next 12 months. Sales growth, now not something you want to see, quite a large slowdown in terms of the growth, 9% in 2025, 8% on a trailing 12 month. Remember, these are all factors you can incorporate in the margin of safety. Sales though, when we zoom out, looks very strong, and it's the first one today where we see the opposite of those prior, where we're actually getting you being diluted as a shareholder. Shares outstanding have been increasing over the period. ROIC leaves a lot to be desired. We don't even get 1 year of double-digit numbers, and operating margin very, very inconsistent. Whilst we want to see consistently above 12%, we just get that in the last 2 years, although we have to say it has been increasing from 2023, a trend we expect to continue, especially if you've seen us talk about this company before, how they are using AI on a lot of their tasks. Free cash flow margin, very strong, that is increasing, now sitting at 33. Net debt to EBITDA, phenomenal, won't even take them 1 day to pay off all of their debt, net of cash on hand, consistently expected over the next year as well. Now, intrinsically, $371 derived using an 8% growth rate. If you believe 12%, then that is just over a double at 105%, with only 1.8% baked into the numbers as of today's date. Now, when we talk about a margin of safety, you are getting at least 30% up to $260, 35%, $241 is where we see it now. Wall Street, they love this, 355. Institutions have been buying 48% upside. Salesforce, give us your thoughts in terms of a buy, hold, or sell. And being even more conservative at only 4% year on year, you're getting 10% at 252, 15% pretty much around where we see it. So these companies do have a lot in common. We're talking high upside as well as in fact a very attractive margin of safety, but let us know on Salesforce as well. We then move on to Okta, up 9% over the last year, up 19% year to date, but trading around the mid to low end of the 52-week range. Double buy from Seeking Alpha and Wall Street with a forward valuation below the 30 mark. And their most recent earnings, we did see a double beat, which was in fact growth on the earnings per share and revenue year on year, quarter on quarter. And their growth does look good at a B+, 14% last year, 12% expected this year, above the sector around the mid-single digit. But like others today, we are seeing a slowdown in terms of their historical performance. Earnings per share projected 20%, very good considering sector at 14, but again, historically well above at 34%. Now, institutions, 87% ownership, selling $2 billion in the last year, buying around double at $4 billion, whilst also buying more than double in the most recent quarter. Again, reversal of the trend where they have in fact sold more. Q3 2023, institutions very bullish on Okta. Now, free cash flow per share has been pretty much climbing from 2020 where they did report positive, expected to continue into the next 12 months. And whilst we love double-digit growth, we see that every single year, it has been slowing down, so we wouldn't be surprised to see that trend in fact continue. But just look in 2016, they reported $90 million in sales, 2025, $2.6 billion. Similar, as we've just highlighted, Salesforce, they have been diluting your position, which they continue to do every single year. Bear that in mind. ROIC, not the greatest. In fact, we get negative nearly every single year, 0% on a trailing 12-month basis. And operating margin pretty much highlighting this company hasn't been profitable, maybe something we expect to see in 2026. trailing 12 month sitting at 1%, although free cash flow margin is looking very strong in the most recent years, 29% on a trailing 12 month. Balance sheet also very good. Won't take this company one day to pay off all of their debt from 2021, expected to continue into next year. And our intrinsic value of $136, as you can see, 8% growth rate, 2.2% is what is baked into the numbers as of today, and there is growth no matter which rate you see if you believe these to be applicable, but using 8% as always the middle rate at 30% is where we see this now at $95. 35, you have to wait for 88. So Okta, 30% margin of safety, $126 into next year with 35% upside. Give us your views on this one too, but we can also highlight using the lower rate of 4%, you are still getting a margin of safety, 15% around that at $89, 10% around $94. So let us know Okta in terms of a buy, hold or avoid. We then move on to the trade desk, which have been absolutely battered in the pre-market, down more than 30% over the last year, up 4%. Year to date, these numbers pretty much meaningless as they will be updated upon market open, but we are seeing this company in fact down more than 50% year to date. As you can see, 52-week high, $142. Will be ultimately trading towards the lower end of the 52-week range, and we have here Wall Street and Seeking Alpha double buy. Now their earnings, as you can see, was in line on EPS, a slight beat in terms of the revenue, double-digit growth on revenue year on year, 5% on EPS, but just from the previous quarter, looking very strong. And it's one that just last month was included into the S&P 500. And we can see the main reason for this drop, even though they did beat on those earnings, was a slight miss on their Q3 guidance. We also got a departure, something that wasn't expected from their CFO. So all of these things have ultimately really hurt the company. And we can see Forbes, like they were talking about, in fact, Fortinet yesterday, believe that this one similarly is a buy right now. In terms of growth, A-, 25% year on year, 20% expected this year, well above the sector, but again remember the valuation is at a premium. Over the last 5 years though, they were growing slightly faster, with earnings per share projected 32%, that is well above the sector, but actually above their historical 29% too. Institutions, 68% ownership, selling $4.5 billion, buying around 50% more at 6.4. Continue that buying trend in Q2, pretty similar in Q1, reverse of the trend Q1 2024. Overall, institutions have been net buyers. And another company where free cash flow since turning positive has been for the large part moving in the right direction, expected to continue into the next 12 months. And even with sales starting to slow down, we're still talking double digit fairly strongly, 26% in 2024, with some incredible growth over the period. Put this one down as another one that has been diluting your position as a shareholder in the last 10 years, but unlike what we did just get to see from the previous company Okta, this one ROIC looking a lot better, at least it is positive, 10% 24, 12% trailing 12-month basis. Operating margin, not something I particularly like to see. This is deficiencies where margins have been moving in the wrong direction. Free cash flow though, for the large part, very strong, very healthy, 27% on a trailing 12-month. Net debt to EBITDA, 0 across the board. You already know what that means. Very strong balance sheet, something we like straight off the bat. In our intrinsic value of $95 derived from a 20% growth rate does highlight one of those with a larger number baked into growth at 13.5%, but if you believe it should be lower at 15, you do still see upside of 10%. Now for those that believe 20% to be appropriate, at a 20% margin of safety, looking like a buy at $76, at 30, 66, and at 35 is where we see it now. In terms of Wall Street, $95 into next year, 53% upside. Give us your views in terms of a buy, hold, or avoid. And if we do show you at the lower rate of 15%, you are still getting a margin of safety around 10% as of now. TTD though, are you buying the dip? Let us know. We then move on to Mercado Libre, one up 26% over the last year, 37% year to date. Over the last 10 years, massive outperformance of the S&P, but we have noticed a pullback from 52-week highs of $2,645. We get our first strong buy rating from Wall Street, a buy from Seeking Alpha, one of the more pricier ones today at a forward valuation of 49, and their earnings just days ago did highlight quite a substantial EPS meet with a marginal revenue beat, and it has already started to recover, as in fact we can see from the share price alone. And the reasons for this EPS drop, they say pressured by rising costs, in particular to their free shipping policy specifically related to Brazil. However, they do continue to expect to expand across the region, and they say here they're trying to balance short-term profitability with growth opportunities that they see lying ahead. Growth very strong at an A, year-on-year 36%, moving forwards 34%, well above the sector, but actually surprisingly, this company has grown historically at such a phenomenal rate. EPS projected 31%, above the sector at 10%, but lower than what was very strong on a 5-year at 46%. Now, institutions with their 88% ownership selling $13 billion bought pretty much the same amount, and we see that continuation in Q2. More often than not, they're neither net buyers or net sellers. Quite an interesting thing. Now, free cash flow has really ramped up in the shorter term, but is expected to cool down over the next 12 months. With sales growth still looking very, very strong, perhaps we can see why it is trading at such a premium. In terms of shares outstanding, another one, although not massively, but they have been diluting your position as a shareholder. One thing we would say, in the case of Meli, where they have been massively outperforming the S&P, probably not something you would worry about. ROIC, whilst inconsistent, has been strong over the last few years, sitting at 16 on a trailing 12-month. And one thing we would say on both margins, we would like a little bit more consistency, although free cash flow looking strong, 34% in 2024. Net debt to EBITDA not as strong as those we have seen previously, but we still note 1.3 below the maximum 3 we want to see at the upper threshold, expected to lower into next year at just below 1. Now, intrinsic value at $3,268, as you can see, is derived using a 6% growth rate. Just look at the last year at 52%. You could say very, very conservative, with 1.4% baked into the numbers today. So at 6%, in terms of a margin of safety, at 20%, 2614, at 25, 2451, and at 30, 2287. So you could say Mercado Libre, if you believe in these numbers, a 30% margin of safety. Wall Street themselves see 25% upside into next year at just under $3,000. And using a 2% rate, which does look to be extremely conservative and unreasonable, but we will highlight, 10% margin of safety, not quite there. We're talking around the 5% level. So Meli, like others today, give us your thoughts where it sits in terms of a buy, hold, or avoid. And don't forget, as always, to sign up to the free weekly newsletter. Grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.